Royalty and streaming companies are a popular choice among expert investors, and many agree that they are a good place to put money. The main benefit of these companies is that they offer exposure to exploration and mining companies without the drawbacks typically associated with those types of companies. To find out more about these companies, the Investing News Network asked CEOs and analysts in the resource space to explain what makes them a compelling investment. E.B. Tucker of Metalla Royalty and Streaming and Scott Close of EMX Royalty both highlighted that royalty and streaming companies are typically less risky than regular mining companies.
You need to have some physical gold before you buy any gold mining stock. But the gold mining business is just a horrible business. I mean, there's thousands of companies, they're running around the world, blowing things up, looking for gold in the ground, doing this humble work, and it's really tough to pick the winners. Even when you're an expert, it's really tough to pick the winners. Royalty, you get 1% or 2% of whatever they find on that property forever. And to me, that's very appealing. I mean, it's like having a tax on all the productive activity in a certain predetermined zone.
Because royalty companies are much less risky than pure exploration or mining companies, because all we're doing is collecting a check every month from the production of a mine. We don't have to build the mine. We don't have all of the risk that's inherent with mining. We're just collecting a royalty.
Trey Wasser of Eli Gold Royalties pointed out that royalty and streaming companies tend to outperform typical mining stocks.
If you look at the royalty and streaming companies for over the last 10 years, they've significantly outperformed gold, and that's because they give leverage on the exploration up and as well as the upside in the gold price. They have outperformed all other mining companies, which actually have underperformed gold, the gold equity indexes. And most importantly, people should buy royalty companies because the top two royalty companies, Franco-Nevada and Wheaton Precious Metals, have outperformed the S&P over the last 10 years.
Ian Farmer of Osisko Gold Royalties said that these companies tend to see their share prices move faster when metals prices rise.
Gold price has been pretty depressed over the last 5 to 10 years. There's been lack of investment in the mining space. We think that currently we're in a period where gold price is going to turn. And if that happens, royalty companies have no lead time. There's no permitting or development timelines that we have to meet. We can see appreciation in our stock price as the gold price increases.
But how can investors choose the best royalty and streaming companies? We asked Adrian Day of Adrian Day Asset Management and Randy Smallwood of Wheaton Precious Metals what they had to say.
What you have to look at, I think, is the execution that a company has done over a period of years. Obviously, the larger royalties with more diversification in their revenue stream, and when I say royalties, I'm talking about royalties and streamers, the larger companies with a more diversified revenue base obviously are safer, because if something goes wrong at one company, it doesn't sort of destroy one mine, it doesn't wreck the company.
In any resource investment, you have to look at the quality of the assets. It's the foundation that any company is built on. It's why we put so much focus on the technical due diligence process. It's why the CEO, myself, I'm a geological engineer and I come from an operating background, constantly drive the technical due diligence. And I've seen the business model is a very good business model, but only if you have good foundation assets to build into it. We've seen lots of companies come in and make all sorts of mistakes in investing into the wrong assets. And there's going to be a few successes. There has been a few failures. It's a matter of how strong, how high quality are the assets themselves, and that's where we differentiate ourselves.
Finally, this is what CEOs and executives had to say about what makes their royalty or streaming company unique.
Sandstorm has really focused on projects that have exploration upside, so large land packages, prospective ground, and we've really focused on that. And so one thing investors get at Sandstorm is exploration upside that you don't have to pay for. We've invested in the assets, and the companies themselves are drilling on them, increasing reserves and resources, which just further adds value to our streams.
We largely build our royalty portfolio organically through the prospect generation business model. So every time that we partner off or sell a property, we hold a royalty back, and so that way we're not writing big checks to build our royalty portfolio. That being said, we do augment our organically derived royalty portfolio with royalty acquisitions when we can find those at favorable pricing valuations.
We pay the highest dividend in the space, and we also have an accelerator model whereby we invest in early stage companies through equity and early stage royalties. And this allows us to benefit from what are the best assets that are currently being developed in Canada. We provide technical and financial assistance and accelerate the development of the next best assets.
We're in Africa, so that sets us apart. And we also generate our own royalties. So we're an exploration team. We have 16 geologists. We're in 6 countries. We have around 20 assets, diversified by commodity, diversified by geology, diversified by jurisdiction. And we're making the discoveries, partnering them with institutions, investors and other mining companies who invest in those assets, so our shareholders don't have to take the risks and don't have to use their money. And we then end up with a royalty on that asset, but in the meantime we get paid milestone performance, we get paid cash, and we have our costs covered by the partner. So that makes us a bit different.
Early stage royalty companies like ours tend to perform very well in the early years. At a $30 million market cap, we've got a long ways to go, and we're able to see transactions that can really move the needle for our stock and our shareholders that are deals that fall below the radar of the other companies. So, we feel like we are just a few more deals away from being re-rated as a junior company and moving into that $100 million to $300 million market cap space.
Whether metals prices go up or down, royalty and streaming companies can be an interesting option for investors. Just remember to do your research before you jump in.